Amy, it's good to have you on. Mark, would you say that gridlock is sort of being indicated by what we're seeing in the options market? It's very quiet right now, which would possibly indicate that that's at least what the market think the outcome is going to be?
Good morning, Joe. I would say definitely. You know, the options market I would characterize right now as behaving pretty nonchalantly ahead of both, midterm elections and also CPI soon. And, you have VIX kind of selling off after kind of important information last week. So I would say consensus at this point is gridlock. And essentially that means that the tail is a blue sweep, which really isn't being priced in to the derivatives market at all right now.
Okay, so that's the tail. And it's tough to go beyond that, other than using a predict it might be, the website might be as accurate as whatever the options markets are telling us right now, whether it's a full sweep of the House and Senate or whether we have a split, a Republican House, Democratic Senate. You can't really tell.
Yeah, I wish I could, but I think the way the options market thinks about it is as long as you don't have a blue sweep, you do, in effect, have gridlock, even if we get swept by the Republicans just because of the White House. And as long as the uncertainty of there being major regulatory change being passed is not there, then, they kind of view it one and the same in terms of how the hedging patterns shake out. And, we can also dive down to the sector level because obviously different sectors are impacted, industrials, energy, et cetera. And you're not really seeing noticeably, people buying calls or puts one way or the other that would indicate that maybe we thought Republicans were going to win both or not. It's just, really marginal in terms of midterms, I think, this year compared to a lot of different years. And frankly, people are just much more focused on a priority of CPI rather than, I think, the outcome of the elections right now.
It's pretty amazing that the CPI is more important than the midterms. You did mention a couple of trades. There's a put spread if the Democrats were to sweep on the industrials, that could be affected, and then what was a call spread on energy if the Republicans sweep?
Yeah, that's exactly right. One way I talk to investors about options is obviously you have to think about things being low probability, but maybe really high payout. It's no different than wanting to play the lottery when it's, $1.6 billion. You get to a point where the payouts are so attractive relative to the probabilities that even if you think, look, probably we're not going to see a blue sweep, but if we do, we're getting these really huge payouts compared to history, then it might be compelling. And industrials is an area where we think might be a little overbought anyway, just because of the rotation we saw in cyclicals. And so if you want to play kind of maybe overdue sell-off from a technical perspective on XLI, which is the ETF proxy, that payout looks attractive on that put spread, and vice versa for energy, which, if we get a complete Republican win, then you believe maybe there's some of these regulatory changes that won't go through. You have that positive certainty, and then you get, upside back, and you can leverage that through those call spreads.
Another interesting point in your notes about mega cap tech and how the sell-off in recent weeks, it really changes the makeup of ETFs and other things. The whole emphasis on that big cap tech had has been lessened. So what should we do with that information?
Yeah, 2 years ago, Joe, during the pandemic, if you own SPYs, you're implicitly taking a view on 7 stocks, just because of how heavy the weights were. That's even more so for NASDAQ, where about 50% was essentially 7 stocks. And one stat that I like to look at is Facebook essentially went from a 22% weight in the XLC, the communications ETF, to a 12% weight. Just think about the trillions of market cap lost. So what does that mean? I think on an S&P level, that means your volatility and correlation is changing dramatically because you're now getting large cap weights that aren't necessarily tech. Maybe it's a J&J, maybe it's a financial, maybe it's an industrial. But it means that that correlation within the S&P is going to start to be less than it otherwise would be if it was all tech, which overall dampens your volatility. And that has a lot of implications for people who trade options when they think about trading it on the ETF level.
Interesting. So the volatility is affected by the future volatility affected by the past performance, recent performance of the mega cap tech. Interesting. Amy, thank you.